Welcome, everybody. After the on Yahoo Finance starts right now. I'm Brad Smith here with the illustrious and talented Seana Smith. We back, baby. You know what it is. There's rabbit season, duck season, and earnings season. And we just got off of Netflix earnings call. And Seana, the stock has been on a roller coaster since reporting its mixed first quarter results. I want to go straight to the Wi-Fi Interactive and just take a look at this after hours move. I've got all of the streaming names pulled up here for our viewers, and this after hours move that they're seeing below what was today's move. And I'm going to zero in on Netflix here and pull that out. As of right now, down by about 0.6% or 0.5% after hours. In the extended session, we've been seeing this move around. And even now, as I'm loading up this chart, it's moving around. Still down, though, by about 0.1%. But here's what that coaster activity was that I was describing. After the close, this has moved lower by as much as 8%, only to then retrace some of those losses and get into positive territory, up roughly 2%. And so even as the call was going on, you saw that movement start to fluctuate, move back towards kind of the flat line, towards where it had closed on the day, and ultimately netted out at the end of the call with the Netflix executives down fraction of percent. So continuing to kind of track some of this activity, Seana, but I got to get your takeaways from what was ultimately a mixed quarter for the company. Revenue that missed expectations slightly on the consensus side from Bloomberg estimates, and EPS that was a slim beat there.
Yeah, certainly, Brad. I agree with you. I think it was a mixed quarter. It was also a bit of a mixed call as well. They were able to reassure some skeptical investors out there, some skeptical in the street following their earnings miss, following the fact that their subscriber growth during the quarter came up very late when you compare it to what the street was looking for. But there was no earth-shattering headline, I didn't think, coming out of this earnings call. The executives there were very measured, giving some detail and not too much. But a lot of the big focus clearly was on the crackdown and password sharing, and then also the little detail, if any, that they gave on ads. But a couple of key takeaways that I had from this call. The first one was on the password crackdown it's going to go global in the second quarter. Now, this is big. We know that Netflix has delayed it here in the US. They're saying that the US is going to be included in that 2Q rollout. Pricing, though, they stayed relatively vague on that. They said it's going to depend on a market-to-market basis. Now, remember, Canada is $7.99 Canadian dollars, so you could expect maybe the U.S. to be priced around there. But the company did say that the rollout of the paid sharing has gone well, and we know that's a critical question here for so many analysts on the street trying to figure out what exactly that means for the company's future revenue here down the line. The second is that they're still confident in the live events coming after the snafu that we'll talk a little bit more about in a few minutes for the Love is Blind reunion. But they're still confident. They're saying that they might have messed up there, but that they clearly believe that they had the ability to succeed in this area. And then going back to the ad plan there, the little details that we did have on this. Now, they did say that they have a lot of work to do just in terms of what they're doing. They're going to continue to develop some of their features. They're improving some of their marketing and also sales capabilities with Microsoft. They did say that they were pleased with their per member ad plan economics, was the exact wording that was used to describe that. So they do think that they're making progress. I think they were very optimistic. They were positive on this call, but it wasn't enough to really send the stock soaring here after hours, Brad.
Yeah, spot on. And I mean, listening to some of your key takeaways, it sounds like we have a little bit of overlap here because the details that they were vague on, I mean, it sounded like they were very excited. We heard them say over and over again that they were very excited, whether it was Ted, or whether it was the rest of the executive team, Spencer, whether it was Greg Peters, all of them used in one facet or another. Yeah, we're very excited, but they were very vague on some of their details. And especially, and Jessica did a great job asking a lot of the questions that analysts, quite frankly, have probably been tossing around on their own boardrooms, on their own meeting rooms as well, trying to figure out what the future looks like for Netflix, and especially what that growth looks like from here. But it's going to come back to how they're engaging that new member that they're looking to take on and to eliminate some of the churn. Let's remember, based on some of the Deloitte digital media trends that I was kind of looking into prior to this earnings period report for Netflix, nearly half of consumers say that they already pay too much for streaming video on demand services that they use. About a third intend to reduce the number that they subscribe to. And so if you are any of these streaming players, your ears should be perking up to that. and perhaps be even more transparent about the details, the features that you expect to bring to the consumer base, and as well so that Wall Street could wrap their heads around it and adequately price that into the valuation as well here. One of the other things that, quite frankly, I'm just going to give them a hit on here, pre-recorded call, like scramble golf tournament format, it kind of sucks, honestly. I really didn't enjoy it at all. I would really more enjoy if you had multiple analysts, and this is no knock on Jessica at all. We've had her on the show before on Yahoo Finance, and she's always great to speak with about the broader media and entertainment landscape. But I'll tell you what, there's some value in having some of those follow-ups and having more of that live element to it. And I will add this, I think say.com has done an amazing job of weaving in the retail investor perspective. I know this is a stock that has 80% institutional ownership. I get that. But at the same time, there's so many retail investors who are also consumers of the platform of Netflix who want to be able to get a question in there as well. And so I think that's a consideration that a lot of companies should, quite frankly, take on as well. And then lastly here, you mentioned a little bit of this pricing. Content drives pricing here. This was a key takeaway from the call as well. If content doesn't hit, the growth narrative will struggle for Netflix. And that is something that was particularly ringing loud for me, because this is a company that also, in the nation by nation or region by region basis that they go out to the consumer base on with that content, it has to be sticky. It has to make the consumer want to buy into that experience. And quite frankly, that's an acknowledgement that they had to make on the call as well here. And I believe we've got some sound bites from the call that I want to get to as well. A few of them really focusing in on everything from pricing down to what you had mentioned a moment ago within that live element. And perhaps we should go there first, because you flagged this one. And it was a really kind of key, perhaps top of mind portion of the call for a lot of Love is Blind fans out there, maybe.
It was. And I was one of those fans. I wasn't trying to watch live, but I could relate. It's an addicting show. When you're looking forward to it, you want to see it live. So disappointed many fans out there, but they were very positive just on where they see the live product going, their capability, their ability here to compete, because we know so many of their competitors within the streaming space obviously have done this very well over the last couple of months. So let's play a quick bite from what they had to say just about their future in live.
A reunion show that's going to generate news and buzz. It really does play better live when people can enjoy it together. Certainly the Chris Rock stand-up show played out so well because there was so much anticipation for what he was going to say in that set. So when we have the opportunities to do projects like that, we like the fact that we have the option to do it. As Greg said, we were super disappointed to not be able to come across with the live product for everyone who wanted it on Love is Blind reunion. But we're super thrilled that people love the show. And it does point to the kind of love for that brand and for the growing love for those unscripted brands on Netflix. And some of them will be live. And I do think sometimes those results-oriented shows do play out a little bit better on live, and they do generate a lot of conversation. But keep in mind, like Chris Rock, about 90% of the viewing happened after.
Certainly. Well, that really points to the fact, obviously, VOD, that critical viewing there for Netflix, still front and center. But live and this snafu, now they're deciding to look past it. They're not putting too much emphasis on it. I don't think that really surprises anybody. It was clearly a black eye for the company, but they do have a future in this. And I think people are giving them maybe a little bit of a break for this mistake. Brad, they did say that they had 6.5 million people who watched Love is Blind. We talk about how it's so critical to have content that stands out from everything else that is being offered right now. Love is Blind is something that Netflix has offered. It's really resonated with their audience. They need to work on the live aspect of it. I think that's clear from the snafu, from that glitch that happened just a few days ago. But Netflix had Sarandos there, remaining very positive on what we could see from the company going forward.
Seana, I drew a visual representation of a lot of people who were probably trying to watch that live, and here it is.
Pulling their hair out too.
Netflix and pulling their hair out, just making this face while they pull it up on the television or whatever streaming device that they're watching it on. We did have another soundbite that I wanted to pull up here, and it really talks about that pricing. And we really can't emphasize this enough, because this is something that they need to get right, especially if they want to continue to drive this growth narrative for Netflix. And here was Greg Peters, I believe it was, who said this on pricing during the call.
we want to give a wide range of consumers and ideally increasingly wide range of consumers access to our great stories at a range of prices with appropriate, corresponding features. The second goal is thinking about optimizing long-term revenue. And, a good example of this is, based on the economics of our ads plan, based on the limited switching behavior that we've seen off of standard and premium. We've upgraded the ads plan features, both in terms of video resolution or video quality and number of concurrent streams, because we think it supports both of those goals. So that's a good example of that. I would say beyond that, we've got, we'll continue to evaluate as we always do. You've seen us make moves in this space before.
And so the key here too, and even as they're weaving in the advertising model to that pricing strategy as well, is that advertising can be such a high margin business for them if they get it right and they don't see a massive turnout of consumers who aren't satisfied with that model or the relevance perhaps even of ads, as that could deter some of the users as well. But at the end of the day, I think through to some of the numbers on the operating margin front, where even going forward, they're forecasting from here, seeking to expand operating margins to 18 to 20% and generate at least $3.5 billion worth of free cash flow. That's up from their prior expectations. This is all going to be derivative of what that pricing strategy looks like as well. And so, even as they were talking about the penetration into certain markets and having more of the price selectiveness within the more affluent markets versus others, I think that strategy is going to continue to be one that they get peppered with questions about from the analyst community, as they should here, Seana.
Yeah, they certainly should. We know that that is critical there for future growth, for the future revenue opportunities. We've heard that numerous times here from the analysts on the street. All right, Brad, let's get to our vibe checks, because we got to dig deep a little bit here, trying to figure out our big overall takeaway. And we redid this, I believe, this is the time that we're debuting the vibe checks like this. So now it's on a numerical scale, a 0 to 5. I'm going to go right in the middle with a 3, because I thought it was a fair call. I thought it was okay. Nothing on this really stuck out to me. Nothing made me think of Netflix any different than I did going into this. They didn't give many details like we have been saying, but they were very upbeat just on what they have seen so far. In terms of the crackdown on password sharing, they said that they were, quote, pleased with the per member ad plan economics that they have seen so far when they were asked just about the average revenue per user from that plan. Again, light on the details, and I think it's something that the street wanted to hear and was hoping to hear a little bit more about. What did you think?
No, I think that's spot on. I am going to also, for my vibe check, give this a 3 out of 5. I'm right in line with you here, and I'll even add, I don't know if they can put my camera back on for this particular part of the vibe check, because illustration to bring back into the chat to go along with my vibe check. And here's why. Where was the talk about the free cash flow? That was perhaps one of the better elements of this report, a huge surprise to the upside. It actually beat on even the high level of the consensus expectations for free cash flow for the quarter, came in at $2.1 billion, just above that. It was expected to come in at just about $900 million. And so ultimately, I think there wasn't enough focus on what that free cash flow could do in terms of some of the dry powder that gives them and really driving back towards their goals of content production in order to get into certain regions and have favorability. They're looking at this $17 billion spent on average between fiscal year 22 and into 24. And that's on average. So they're really going to be looking to ramp it up to get back $17 billion by fiscal 24. And so the free cash flow that they're going to be able to generate, I think that's something that they could have leaned into more as that being the next wave or the driver of the next wave, or one of the catalysts of this next wave of the leg of growth for Netflix here. So I don't know. I think that just could have been leaned into a little bit more. And that was really what had me drawing on my desk over here on my small notepad. It's very Picasso.
I never knew that you were such an artist.
Such an artist, it's just in my blood.
To the point. Let's get the point across.
Exactly. It's kind of like I'm on Main Street drawing with some chalk. That's just what I did here at my desk. Speaking at Main Street, let's bring in Yahoo Finance's own Alexandra Canal, who's got the breakdown for us of Main Street versus Wall Street here. Ali, what are you hearing?
Hey, Brad, welcome to Main Street. We have some Twitter reactions on the volatile price action we saw from this stock, in addition to some general thoughts and maybe even some frustrations when it comes to Netflix's content, especially amid this competitive landscape. But let's start with those stock moves, because as you painted earlier in the show, it was a big doozy. This Twitter user writing, quote, Netflix down 12% after earnings and climbs back up. Wow. It's crazy to see Netflix go from 180 plus to 300 plus now within months. A streaming company that is probably going to make money more. Bullish analyst commentary surrounding Netflix. Across the street, we have 26 buys, 25 holds, 4 sells. That's according to Bloomberg data. And we don't have a heck of a lot of information on scale and engagement. This possibility of better days ahead seems to be driving this bullish sentiment overall. So I think analysts, investors, they're willing to be patient for now, but we will likely need to see some more specifics in the back half of the year, since as we saw in those stock moves, the market gets a little spooked, a little antsy when a company like Netflix shows signs of slowing growth, whether that be for revenue or for subscribers. Now, moving on to tweet number 2, this user not holding back, saying, quote, Netflix has very little worth watching. Now, I want to quickly kick it to you guys, because for me, there are times where I watch Netflix and it has a ton of content that I'm interested in. And I think there's a lot to watch, but nothing that I'm genuinely interested in. So relative to the competition, real quickly, do you guys think Netflix has the content that makes it worth keeping?
Depends upon the time of the year for me. I mean, I'm in NBA playoff season right now, so it's tough to pull me away from that. But I would say that they got some content. Beef is good, and Love is Blind is my guilty pleasure.
Shauna?
So I have a few subscriptions. So I think Netflix is always the streamer that I think is worth keeping. I've thought about it. I've also canceled some of my other subscriptions, but Netflix on the content front, I've been pretty happy with it.
All right. And this brings it full, if you will, to my last tweet. Netflix, shuttering its DVD business after 25 years. The announcement made just prior to these earnings results. Jeff H. writing on Twitter, quote, I only have Netflix, Hulu, and Disney Plus, and the latter two are included with my phone. Netflix DVD lets me see most of what was on the other streaming services without actually paying for those services. And that's an interesting point. I had not thought about adopter the Netflix DVD. I'm sure there's some loyal fans that are disappointed to see this go, but Netflix saying that it's been hard to provide the best service as the business, quote, continue to rank. So out with DVDs and embrace some of these new revenue drivers like the password sharing crackdown and ad supported, which we definitely heard a lot about on the call, but I agree with you guys. Very vague. I need some more details. See if we'll get there in the back of 2023.
Just briefly, to your point there on competition, they had in this earnings release that their competitors really are focused on diversification as they manage the hard transition from legacy businesses to streaming. Netflix, though, been about this life. They are all in, and they continue to down on that, not focusing too much on competition, but already generating profit and free cash flow. See if that is the story, the narrative that they're able to sell to Wall Street and a lot of those subscribers out there, Ali.
Yeah, I totally agree. And in that release, they did say, live sports, that's not something that we're really looking forward to right now. And then on the call, they also shut down the fact that, they want to go to theaters, which we've seen from competitors like Amazon and Air, that movie doing really well for that tech giant. But Netflix really hardcore saying, we're not about the business of bringing folks to the theaters. We want them to sit on their couch and watch Netflix movies made for Netflix, by Netflix, for our Netflix users.
All right, Yahoo Finance's own Ali Canal, breaking down Wall Street versus Main Street. Ali, thanks so much. Shauna, we got to go here. I want to give you the first word on the final takeaway here from Netflix.
Final takeaway, I think it's all going to be about the second quarter here. I think at the end of the next quarter, we're going to have a better picture just in terms of the password crackdown rollout, what exactly that meant for the U.S., a little bit more detail. I'm hoping just about their ad tier, what we could expect here going forward in terms of the growth plans that they do have for their ad streaming service. And then also games. That's something we haven't mentioned. It was briefly brought up. They were asked if they do have any plans to directly monetize games, to which the answer was not really. But we know Netflix wants to have a differentiated gaming experience than what is already out on the market right now. They have just over 40 games, I believe, on the platform. So gaming is one thing we haven't mentioned, not necessarily core there to the investment thesis at this point, but clearly Netflix sees a reason to invest in that space and also sees it as a massive growth opportunity.
You know, I'm going to end on a light note here today, Seana. I don't usually do this, but I will today. You know, I'm kind of playing Friends Forever by Vitamin C in my head as we pour one out for the DVDs. We're not going to see them anymore. Bye-bye.
I was an early subscriber.
Yes. Nostalgia Lane. Getting the red DVDs in the mail. My goodness. I remember that's all you needed to turn up back in middle school and high school. Now I got to make sure that my internet connection is stable. Not always. Seana, thanks so much. After the call with Netflix, that wraps us up here. We've continued to track this after hours move. Of course, we will be back with you tomorrow, 9 a.m. live here on Yahoo Finance. You've been watching After the Call with Brad Smith, Seana Smith, as well as special appearance featuring Alexandra Canal. Thanks so much, everyone. See you soon.